What's up guys, I'm Joseph Graff and I'm back at it again with another investing video. I made a lot of purchases this week, so without further ado, let's get into my portfolios and I'll show you what I bought. Let's get it. Alright guys, so here we are in my Robinhood portfolio, and like I said, I decided to pick up some shares of a couple different companies this week, and I will go ahead and show you all them. So I talked about it last week, but last week I bought some Waste Management, Procter & Gamble, Coca-Cola, as well as the Schwab Dividend ETF. This week I decided to pick up a share of the Standard & Poor's 500 Index Fund. I picked up 5 shares of Realty Income. I had also bought 5 shares of Kraft Heinz this past week. This week I bought 2 shares of Johnson & Johnson as well, and 1 share of the Vanguard Total World Stock Index Fund. So this index fund is a fund that I really like because it is extremely diversified. It tracks an index of the largest companies in the world. So not only are you getting U.S. exposure to the stock market, you're getting exposure from pretty much the whole world, which I think is absolutely awesome. I'm going to be looking to add more and more shares of this to my portfolio in the future, as I think it's just a really good diversified fund. Johnson & Johnson I decided to buy because it's a company that I really do like, and it was, in my opinion, pretty fairly priced. I think Johnson & Johnson has a pretty recession-resistant business. If there is a recession, I don't think they're going to do too horrible, and at the very least, I think they're going to keep their business up and running. And Johnson & Johnson actually went up 8% today because of the news that the government selected them to be the producers of the coronavirus vaccine when that vaccine comes out. So pretty cool stuff. I'm already up 8% on it. Pretty happy with that. Of course, Realty Income hasn't done so hot for me. I'm already down almost 8%, almost 9%. I think real estate investment trusts have really gotten hit hard lately. Real estate investment trusts usually operate on pretty thin margins, so anything bad for them usually can spell trouble. So I'll have to keep my eye on Realty Income. I do think it's a solid company long term. I am a little bit worried about this current economic climate and how it might affect them. In theory, they should be okay because they are what you call a triple net company. Their tenants pay rent. They also pay for maintenance, and there's one other thing they pay for, but I can't remember. But anyways, their business model is supposed to be pretty recession resistant, and it's pretty risk proof. I would say it's not completely risk proof. Of course, they have problems when their tenants can't pay their rent, like what we might be facing here in the near future. But overall, I do like Realty Income. Kraft Heinz is still a purchase that I'm pretty happy with. I think it's another good defensive play. I'm already up 10.7% on it. Pretty happy with that. So about, I think three weeks ago, I decided to sell all my shares in Robinhood. And that's just because I felt like the stock market was just headed down and down and down. So I wanted to get into cash. I got out where I was only at around an 8% loss all time. I have made it up some ground the past week or two. And I don't regret that decision. I think I sold my shares right around when the Standard & Poor's 500 was at around the 250 range. And as you can see, it's up higher now. Personally, I don't think we're out of the woods. I think this could drop a bit further. I really wasn't expecting this large of an economic stimulus package. I think for the short term, it'll be fantastic for the U.S. economy. It'll help get businesses up and running again, help restaurants stay on their feet, help companies like movie theaters stay on their feet. But long term, I'm kind of curious about what the ramifications are. I mean, we did have to pay $2 trillion for this stimulus package, and you would at least think that that money's got to come from somewhere. So I wonder if we're going to have to pay for it down the road. Waste management has been another one I've been pretty happy I picked up. I really love waste management. I talk about it all the time on this channel. My theory is that there will always be garbage. I'm very happy with the earnings that waste management posts. I think the coronavirus may lead to less waste from industrial and commercial properties, but I know waste management also has a pretty strong foothold in the residential garbage pickup, so I think they'll be fine. Procter & Gamble, just another company I love, very defensive play, kind of like Kraft Heinz. Coca-Cola, same way. Schwab Dividend ETF is a ETF that I have always loved. They hold some really great companies in there in this ETF. Very happy with it. And yeah, I think with that, I don't have too much else to talk about. I guess one stock that I do kind of have my eye on is Wendy's. So the reason I kind of like Wendy's is I looked at it and it's been down 32.6% in the past 3 months. And I consider Wendy's very similar to McDonald's, both fast food, pretty similar business model, I'd say. McDonald's is only down 15.4% in the past 3 months. Now, I attribute most of these losses due to the coronavirus and all the fears surrounding it. So I suspect that maybe Wendy's has dropped down lower than it probably actually should be priced. I really wish I could have picked up some shares when it dropped down to around $8, which was pretty crazy. If you see here, it was down almost at down around $7.50, which is pretty crazy to me. Obviously, hindsight's 20/20, but I may look to pick up some more shares of Wendy's here in the future. I think they have some strong opportunities for growth with their breakfast line that they just came out with. I think a lot of people have been really liking their breakfast. I think people will continue to eat lunch and dinner there. And I think when all these fears surrounding this virus are over, I think that Wendy's will emerge stronger than ever. And I really do like Wendy's, and in thinking about trying to pick up some shares while it is down in this range. So with that, we'll go ahead and jump on into my M1 Finance portfolio, and I'll show you all how that has been doing. So here we are in my M1 Finance portfolio, and I'll start out by showing you all how this portfolio has performed. So over the past day, I'm up 2%. Over the past week, I'm up 18%, which is crazy. This past month, I'm still down 16.5%. This quarter, I'm down 28%. And all time, I'm down almost 38%. So I've talked about this before, but the purpose of this portfolio is to grow my dividend payments over time. And I try to contribute at least $100 or so, at least on a bi-weekly basis, sometimes more frequently than that. So I'll go ahead and show you all the dividends that I've received this past week. So on March 24th, I received 6 cents from United Health Group. On March 25th, I made a $100 deposit. On March 27th, I received 9 cents from Bank of America, and on 9 cents, I received 9 cents from Chatham Lodging Trust. So something I want to talk about today is M1 Finance actually made some changes to how they operate, and essentially what is going on is that they are putting a minimum stock buy of $1. So you have to at least buy $1 worth of any stock. And then the minimum amount for you to be able to auto invest your money is $25. So this change makes it pretty difficult for my portfolio because I have shares of 100 different companies, which is quite a bit and probably too many. So something I'm kind of considering doing is I might just go ahead and pick out my 3 or 4 favorite stocks from each sector. And that should get my number of holdings down to around 30 or 40, I believe. And that should kind of help me out in the future because of these new investing rules. And also, I've been wanting to kind of trim this portfolio down. I started it and I bought 100 different dividend stocks because I thought it'd be cool to see these dividend payments all the time, no matter how small they would be. And it has been really cool. But the hardest thing to do is to manage these companies. It's just very difficult to figure out which companies are doing poorly, what companies I need to get rid of, what companies cut their dividends, because I have 100 different companies that I got to keep an eye on. And it's just getting to be a little bit too much. So I think I'm going to try to cut this portfolio down to 30 or 40 different companies. As you can see here, my best performer all time has been Equinix. I'm up 33% on them. Digital Realty Trust has also done well. I'm up almost 32%. Clorox has also done fantastic for me, up 23.5%. Now we'll check out my losers, and I have some losers. Interplus has done horrible for me. This says they're down 99.5%. Keep in mind that M1 Finance has kind of a funny way of calculating your return. It's a money-weighted return. So I haven't actually lost 99.5% of the money that I invested into Interplus. Chatham Lodging Trust has also done pretty bad for me. And Simon Property Group is also hurting quite a bit. So overall, this portfolio is still down 37.7% according to M1 Finance. If we look at my actual losses, I've lost about $350 on a $1,600 investment, which translates a little closer to 20 to 25%. So really not as bad as it looks. I'm going to continue investing in this portfolio. I might trim it up, like I said, but overall, I'm going to stay the course. I really like the idea of this portfolio, seeing these dividend payments grow over time. It's something that really keeps me interested in investing, and that's why I really love doing it. So with that, I think I'm going to end today's video. I appreciate you all watching. If you enjoyed the video, please hit the subscribe button down below. Please like the video, and I will see you all next time.